Good afternoon and welcome to the HEADLAM Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Chris Payne, CEO. Good afternoon to you, sir.
Hi there, and thanks to everyone for joining the presentation today. I'm Chris Payne, the Chief Executive, so I'll be just taking through the year-end results for 2023 for HEADLAM Group. I'm also joined by Adam Phillips, who's online with me as well. So we're presenting separately just for ease of seeing us on screen together. So at the appropriate moment, I'll hand over to Adam to cover some of his slides. So yeah, just four main areas. So I'll give a very brief introduction to the business, an update on how we see the marketplace, and then Adam will cover the 23 financial performance in a bit more detail before handing back to me to pick up some of the updates on the strategy, how we're getting on operationally before we close with an outlook at summary. And as Alessandra said, there's plenty of opportunity for you to ask questions either through the presentation. What we'll probably do is just come back to it at the end and answer them at the end to save breaking up the flow of things. So without further ado, what we might do is just probably do this slightly quick canter through, because some of you may have already seen this presentation before, and it's available on our website too. So I'll try and cover this at a reasonable canter, but say it should take about 25 minutes, 30 minutes, something like that. So HEADLAM, this is a sort of HEADLAM on a page, if you like, and when I normally in the past have talked about HEADLAM, for those who are familiar with the story, we sort of talk about this long heritage, been around for 30 years or so, great UK presence. We were also in overseas territories in France and the Netherlands. And I think the theme this time is slightly different theme, where I've used the word broadening foundations, and that's a link to the strategy, which I'll come back to. But say we've been very focused on the independent retailer in the UK in particular, and also the fitter market, if you like. So we've been broadening that out to cover other segments of the market in recent years, and we'll give an update on that shortly. But say very strong presence in the UK in particular, good balance sheet, strong balance sheet, good product range across the country, and in particular it's a very sort of service oriented approach. And as we've been broadening this business out into other customer types, it's all sort of service and product led. So that's the theme of the business, and certainly will be the shape of the investments that we can update you on shortly. Just an overview, as Adam will cover this in a bit more detail shortly, but there's sort of four main chunks to the summary of 2023 as captured by those segments on the left-hand side. So the first thing to say is, encouraging delivery of some of the strategy. So we've seen the focus on larger customers and that broadening business into those new customer groups. So larger customers, trade counters, real positive performance in the year, particularly given the market backdrop, which I'll come on to in a moment. So it's pleasing to see those elements of the business moving forward, together with our own branded revenue, which is another area of the business that we're looking to pursue, showing an increase in revenue year on year. However, as I said, the market itself has been under pressure. There's a number of macro factors which I'll come on to, and you may have seen in the market more generally, which does point to a tough market, and in particular in flooring space, where residential property transactions, consumer confidence, and spend on home improvements has been under pressure, and we've seen that have a negative effect on our regional business, the longest serving part of the business, where we've got a traditionally high element of our sales in there. So that's had a negative impact on the business in that area. That in turn has resulted in some downward profit pressure. So as we've got a relatively sort of operationally geared business model, then when we do see contraction in volume and revenue in one area, it's led to a reduction in profits, which has been exacerbated by the cost inflation that we've seen in the overhead base. And as I said, Adam will come on to that very shortly. So we saw sort of revenue overall relatively flat, but moving towards the new areas of growth, and the market weakness, which is affecting all of Europe, but obviously the UK business being the biggest part under pressure. And then the third area is just to talk about cash performance. And again, Adam will cover that in a bit more detail, but pleasing to see strong operational cash performance, which has meant that we've had the cash available and generated for a number of investments, whether it be returns to shareholders through buybacks and other means through dividends. But importantly, we've continued to invest in the business, whether it's in the strategic elements of growth that we talked about, or whether it's investing in this regional business, which is so important for service and the majority of our business. So we've carried on investing in the capital of refreshing the equipment, together with expansion into new areas. So a bit of a mixed bag there. And I'll just come on to an additional slide that I haven't normally talked to at length, but thought it was worth adding a slide just talking about the economic backdrop, which affects the flooring sector in the UK. And there's a couple of slides at the end which just sort of does that look forward, what do we expect this to do? So just focused on the sort of 3 or 4 things on this slide that we look at. So what do we think influences the market, in particular in the UK, for flooring demand? So 2/3 of the market is residential product and 1/3 is contract flooring. So consumer confidence and spend on home improvements, which is shown in the top left and bottom left of this graph, shows we've had some pretty weak numbers, both in terms of confidence, but also some quite big negatives actually, and consistent and persistent negatives on spending on home improvements. And that graph at the bottom left is Barclaycard data, which is segmented into the different categories of spend in the UK. And we can see some pretty consistent negatives, sort of close -9, 10 over the last second half, really, in particular the last quarter. And also RMI as a whole category for the UK was down 11% in the year. So some pretty difficult market backdrop numbers there for our space. But housing transactions is the other one, which is worth calling. And of course, what drives residential demand for flooring is often when people move home, they too tend to replace floors shortly afterwards, or indeed as they're getting ready for a house move. Sometimes people do replace floors in anticipation of a successful sale. So there is a bit of fluidity around this market and a bit of buoyancy brought by housing transactions, and we've seen that under pressure recently. Not necessarily new homes, which is obviously a feature of the market, but just the housing stock and the number of transactions generally is really the biggest driver of our demand cycle in the residential market. So all of those things are under pressure, which you no doubt will know about. So just just a bit of a backdrop now, maybe for Adam to talk through the financial performance in a little bit more detail for 2023.
Thanks, Chris, and good afternoon, everyone. I'll start with a bit of a summary slide that gives the overview on the key financial metrics. We do have a few slides. Many of you may have seen a few of them already, so I'll give an overview of a few of them, and then happy to take questions at the end. So just this on one slide here, we've got all the key kind of P&L and cash flow metrics. So as Chris said, revenue pretty flat in the year, and in the UK it was flat. So in the UK we were flat year on year, and then in continental Europe there's a 7.7% decline. And on the next slide I've got a bit more of a breakdown of that UK revenue, with just these sort of areas of strategic growth, as Chris outlined, in good growth in the year, and that offset the residential market impact on regional distribution. In terms of margin, then gross margin. So in 2023, that returns to the pre-2021 average of about 31 to 32%. And as we've talked about before, and those of you who have been on these calls before, we've talked about the fact that in 2022 we had a temporary uplift from the manufacturer-led price increases that worked through from manufacturers to distributors and onto the end customer in 2022. So that lifted our margin temporarily in 2022, and we've seen that unwind in 2023, but we're back to sort of the long-term average of just under 32%. Profit, then operating profit, and I've got a bridge on that in a moment, which will break down those year-on-year movements and explain that a bit more clearly. So we'll come back to that in a minute. Operating cash. So operating cash generation was good. Underlying operating cash flow was up over 100% year on year to 26 million, and was higher than the previous 2 years. worth, and we'll come on to the cash flow also in a minute. Net debt then, so net debt excluding lease liabilities was just under 30 million. That increased by 31 million from the previous year, and that's after investment for long-term growth. So we spent 18 million of CapEx. It was a peak year for us for CapEx in 2023. Come on to that in a minute. We'll break that down in a bit of detail. And then also 6 million of acquisitions in the year. And then on top of that, 17 million of shareholder returns. So that was a combination of ordinary dividends, which are 12 million, and then 5 million share buyback program, which completed in March 2023. And then finally, final dividend of 6p recommended, which takes the full year dividend to 10p. And just at the very bottom of this slide actually is leverage, so we ended the year about 1.3 times leverage. So we've got a long-term average leverage target that we target of 0.5 to 1 times, which we're sort of broadly in that range at the end of the year. So revenue, I mentioned I've got a slide where we just break down the revenue in a bit more detail. So you can see on the chart on the left-hand side there, you can see breakdown of our UK revenue. The areas of the sort of strategic growth initiatives of larger customers then and trade counters perform well, as Chris mentioned, so up 26% and 8.5% respectively. Regional distribution impacted, as we said before, by the residential market and spend on RMI and those factors that Chris outlined on that slide. So that was down 7% in the year. And then Continental Europe, as I mentioned, down 7.7%. And on the bottom left-hand side on this chart, we do a split there of the residential and commercial. So you can see the commercial side of the business actually held up a bit more, was a bit more resilient in the year. And the market we saw there was more robust, and it was the residential side that declined, reflecting the market impact during the year. If I just skip forward perhaps onto that operating profit bridge, then I mentioned, so on here, this bridge here, this waterfall moves from our 2022 operating profit of 39.2 million and shows the movements then to the 16.1 million of operating profit generated in 2023. So the key moving parts then to volume. So we saw a volume decline in the UK business of 5% in 2023. That was in line with the market, ever so slightly better than the market. But that itself drove an 11 million adverse profit impact in the year. You've then got the unwind of the prior year price benefits. That's what I mentioned around the temporary uplift in 2022 from manufacturer price rises. That unwound in 2023 and had fully unwound by the end of Q3. So that's no longer a headwind going forward. That's washed its way through now. The next bar along then, so 3.9 million of strategic investment. So that is where we made cost choices to invest now for better long-term benefit. The majority of that is trade counters, and when we open a new trade counter, it will have an operating loss in its first 12 months. It takes somewhere between 12 and 18 months to get to break even. So we're in the investments phase of those trade counters at the moment, and so they will dilute profit, and they have done in 2023. We expect that to happen again in 24, but to a lesser extent. And then as we get into 2025 and 2026, that trade counter business we expect to be profit accretive. So cost inflation, the next bar along there, so the 10.2 million. So 10.2 million of cost inflation in the year. That's more than double that we'd expect in a normal year. And that's been driven by people and energy costs. So from a people's perspective, where pay inflation averaged around 7% in 2023. And then on energy, electricity costs, for example, were more than double year on year. So as we go into 2024, we expect that number to come down significantly, but it is still a bit elevated compared to historic averages, with pay inflation still a little bit above long-term averages. And then just moving through the rest of this chart here, so Continental Europe declined profit by about 3 million in a year, driven market weakness there, and particularly in the Netherlands. So France a bit more similar to the UK, but particularly weak residential market in the Netherlands during 2023. And then all of those moving parts, all of those were partially offset by mitigating actions, and we worked hard in the year to generate just over 10 million of benefit to offset those headwinds around volumes in the market and cost inflation. And if I just comment to a bit about what those mitigation actions were, so they were a combination of volume and margin actions, so things like volume driving promotional activity, putting a few targeted price increases through on own product brands, which were done earlier in the year in Q2, and then negotiations with suppliers to negotiate reductions in the cost of goods sold. And then cost actions included flexing our operational headcount to reflect lower volumes, and that was achieved without needing to do major redundancy programs or anything. It was just simply not recruiting vacancies. And we successfully managed to flex headcount down about 5% in the UK in the operational roles, and that mirrored the volume reduction of about 5%. And then on top of that, we continued to and then concluded on some of the transport efficiency projects. So there's been a multi-year project on transport centralisation, and the final piece of that was concluded in the year with the dynamic route planning. So that takes out vehicle costs, driver costs, and it also reduces mileage and CO2 footprint, etc. And then there's a bit of a reduction in bad debt provision in the year, which supported, and then generally across the year, other kind of tight cost control and cost savings. So all in all, generating about 10 million of benefit from those mitigating actions. Non-underlying items. So these are items that they're not in that P&L that we've kind of just talked through here. These are non-underlying items. The key point from this slide here is that there's a net significant credit from a cash point of view. So if you look at that first column, we've broken down the non-underlying items into cash and non-cash. Significant cash credit in 2023, and that's because we settled the final element of the Kidderminster insurance claim in the year, which was nearly 9 million of cash proceeds that came in. And then we also sold the land, the Kidderminster land as well, which is another nearly 2 million of cash proceeds. So net 6.5 million cash credit from non-underlying items. There is a non-cash expense, as you can see in here, and largely the large chunk of what that relates to is the bottom two bullet points on the slide here. So during the year, we took the decision to replace the ERP. So we've written off the intangible software assets that are on the balance sheet, and then we also put some provisions in respect of network optimization. So linking back to the mitigating actions for 2023, as we look ahead to 2024, one of the actions that we are taking, as well as continuing to flex variable costs as best we can to suit whatever the market environment is, we are taking a couple of efficiency actions on the network, and we are closing one, possibly two centres and replacing with cross-dock facilities. One of those is Stockport, and so there's some provisions in at the end of the year in respect to that. Just turn this cash flow then, and so I've talked about underlying operating cash flow, so that line in bold about a third of the way down the slide, so 26 million of underlying operating cash flow, which was roughly double what it was in the previous year, and that's despite the reduction in EBITDA driven by the tailwinds from market volumes and cost inflation. And if you just look at the sort of working capital movements, so we successfully pulled down stock and receivables in the year, so those were cash inflows of about 13 million. That was offset by an outflow on payables. Now, some of that outflow on payables is linked with the movement in inventories. So as inventories comes down, payables comes down with it. But some of that was to do with timing over supplier payments. So 10 million or so of that we would therefore expect to reverse over time, and we should expect to see that unwind during 2024. Just moving further down then, the cash flow, you can see below the underlying operating cash flow line, we've got the acquisition of subsidiaries, so 6 million spend in the year, and that was on 3 acquisitions. There's Melrose for about 4 million in January 2023, and a couple of small ones in the second half of the year. CapEx 18 million. So that's our peak year, and I'll quickly show you in a moment a slide that just shows how that's moved over the last few years. So we'll come back to that in a second. Lease payments broadly flat year on year, slightly up as we roll out trade counters. Shareholder returns 17 million I've talked about, so that's 12 million of ordinary dividends and 5 million of share buybacks. Then you've got the non-underlying items, the 10.4 and the 3.9 there. That's the net 6.5 million cash credit I mentioned, mainly to do with the Kidderminster insurance settlement and the sale of the land. So all in all, strong underlying operating cash flow, and a net cash flow before movement in borrowings of an outflow of 31 million, reflecting that busy year of investment combined with those shareholder returns. So CapEx I mentioned, and 2023 was a peak year for CapEx. You can see on the chart there, 18 million. And actually, if you go back the last few years and you look at 2019 and 2020, those looked big years, but actually they were there's big one-off spend there for our Ipswich distribution centre. So if you took Ipswich distribution centre out of those 2 years, they'd be much more like a 2018 year. So before we started the trade counter investment programme, which started properly in 2022, the business long-term sort of average CapEx spend of the business was in the low to mid single digit millions. We're in the trade counter rollout phase now, so and that's been about 6 million a year, and we spent 6 million in 2023. That we expect to cease in 2025, and thereafter then we'd expect a further drop off in CapEx. But looking ahead to 2024, we're guiding to about 12 million of CapEx, so a reduction on the peak year of 2023. That still includes trade counters. Once trade counters drops out in future years, we'd expect that to drop then down into the mid to high single digits as a long-term average kind of CapEx spend for the business. Very briefly on balance sheet, we've talked about this before, but Headlam's strong balance sheet position is underpinned by a freehold property portfolio. So it's on the books for about 100 million, but it's valued at the start of last year at nearly 150 million. And I will just take one of the questions now because it's relevant. I've seen one of the questions is around what do we think is the approximate value of the property holdings now compared to that appraisal that was done at the start of last year. And we think it's broadly about right, that valuation. There's a couple of sort of test points on that have confirmed that. So one is where we sold some land late last year, and we sold it actually quite significantly above the market valuation we previously had. And then on Stockport, which is the property I mentioned that is now up for sale. So that is a property we're looking to sell. It will probably be in the second half of this year. And the kind of soundings we're getting and the view from the agents is bang in line with the market valuation it's had. Obviously, we yet to test the market fully and see what we get back, but that 150 million of property valuation feels about kind of right at this stage. Final point on this slide then, just from a liquidity point of view, significant liquidity headroom. So at the end of December, there was just over 70 million of cash and undrawn banking facilities available to the group. Which point of view, 1.3 times leverage at the end of December. That's probably it for now on the question on the financials. I'll hand you back to Chris, but we'll take some questions at the end.
Thanks, Adam. So I talked about this sort of broadening business model and how this is probably best illustrated. And those of you who've seen Headlam before will be familiar with this slide. We look at the market here, and the UK market we see as being around about £3 billion worth of sales at distributor prices. Now that number, interestingly, hasn't changed an awful lot. And when we first started publishing this number a few years ago, it was a very similar number, 3 billion, and that's despite the market being 20 to 25% lower now as it was to 2019. And the reason for that is that inflation has sort of kept pace with volume decline. So the revenue is broadly as it was a few years ago, which tells you two things. One is that The revenue numbers are quite resilient in that we're reporting, and market share numbers are relatively similar. But secondly is that there is I suppose a missing level of volume in the marketplace, and when and how that comes back, we maybe talk about in a moment. But there's sort of 20-25% of normal, if you like, demand reduction, volume reduction, as opposed to pre-COVID levels. And by no means pre-COVID was a sort of the height of the volume metric. So there seems like there's a bit of pent-up demand there. Now, how it comes back and what the shape of that customer segmentation looks like, we'll find out. But traditionally, Headlam, as I mentioned at the start of these slides, has weighted its sales and energy towards the left-hand side of this slide, so traditional retailers and independent fitters. And that's around about a third of the market. And then as you look to the right, with these other customer segments and multiple retailers is where our larger customers sit, for example. There's other significant elements of the market. So again, over £1 billion worth of sales done there, and Headlam's had very little share in that space. So broaden this business model out means going after as many of these customer segments as possible by offering a slightly different service model and a different ranging approach. So that's the sort of underpin to the strategy and where we see the size of the market. And clearly, regardless of the size of the market, whether it is 20% down or not, our addressable market, if we can broaden that out and make it as broad as possible, clearly it's got to be good for opportunities to growth. And that's what we're seeing come through now in the larger customer growth and trade counters, which is aimed predominantly at the contractor market. So yeah, that's the underpin to the strategy. And again, in the past, what we talked about is sort of strategy on a page. These are the 5 columns of our strategy. Again, if you're new to the model and the Headlam story, then on the left-hand side, this is about service. That's about great service to our existing customers. And then as you move across to the right, the next column is about growth, opening up these new areas, these new customer types, new channels to service them, predominantly through organic growth. And then operational capability is again about being efficient, offering a good quality service in an efficient way, which has led to some of the improvements and mitigating actions to the market that Adam described earlier as well. And on the right, this is about our ESG credentials and being a great place to work for our people. So strategy sort of covers 5 areas: great service and product, growth opportunities, efficiency, and then sustainability and people as a focus. Really, we've got sort of three divisions really to the group now, and this is something I've been developing over the last sort of year or so. Is we've got 3 main divisions now, and again, we're very much focused on the left-hand side, the regional distribution business aimed at those independent retailers, and that's still the biggest part of our business and still remains an important generator of revenue and profit for the group. But we had quite a high share in that space and therefore opportunity to do other things. And it's important, as I said, that we preserve the focus on that area of the business. But I've effectively created new management teams looking at these other parts of the market so that we can broaden our business into other areas. So, these are the 3 ways we go to market, all underpinned with an improving and a developing digital offer, as I think it's important that whatever way we approach our customers, whoever they are, sort of digital and e-commerce engagement is going to be an important part and a growing part of the future business model. So these are the 3 areas and 3 divisions of the business. So if I just give you an update on each of those, regional distribution business, as I said, is the biggest part of the market for us, under pressure from the market share, the market environment and the drag on market demand. So challenging environment, it's affected by the macro. We've been offering and developing new ranges and new products, Every Room being a new one that was offered in 2022, which has really helped support the own brand revenue growth that we're able to report. But even here, and this is an area that I have sort of dwelled on with our own teams, interestingly, is that we've continued to invest in this part of the business. Our business model isn't simply about growing the new areas. It's also about offering this great service and brand and product into existing customers in the regional distribution business. So we've invested in new cutting tables, new equipment, the telematics that's gone onto our trucks that's underpinned much of the improvement in efficiency in the business that Adam referred to earlier. So that's all part of the regional distribution business, and it remains a key focus for the business and where we've got the majority of our people facing into. And that's, as I say, a challenging market, but I'm pleased to say that some of our brands that you can see on the right have continued to perform well. Trade counters, there's a picture of a trade counter there, and it's an interesting couple of things worth picking out on here. So on that picture, you can see the signage that's on the side of the building. It's sort of a blue section, a white section. That reflects the sort of co-branding structure that we've gone for in our trade counter rollout, because many of our trade counters represent local regional distribution brands in their communities, but also a nod to being part of the sort of Headlam floor covering family, if you like. So there's sort of Headlam branding supported by a local branding, and in some cases it's the other way around, where the local brands have got some brand resonance. Many of our customers in the regions value those local brands, so we've preserved those on the signage and supported by a Headlam brand. So that's a typical sort of size and shape of a new facility, and the chart on the bottom right shows the progression of the total number of trade counters that we have or are going to deploy across the estate, and the level in which they're still in the original format or the sort of new invested format. So we're starting to move that bar up. You can see the number of sites has increased over the year, and also we've continued to refresh the old format. So going well. Pleasingly, the revenue performance and the shape of that sort of new sales as a site comes online is trading in line with our original plans, actually. So the original business case that we developed as part of the rollout strategy, we are meeting that. Now, that's despite a pretty tough market out there, so that's encouraging to see. And I suppose it's important that we continue to track that, and I've said that all along, that we'll continue to report this as we go, because we know this is a fair chunk of investment. You know, it's £25 million of capital over 4 years. We're going to continue to monitor this performance of these sites relative to the rest of the business and to see that it continues to make sense. And so far, so good on how these are performing, but we'll continue it under watch. And you say, most of the time we get these decisions right. So location, team, product range, quality, all been good. We've learned things along the way. So as we've learned and developed these, you know, we're now able to make some economies in terms of how the costs are to fit out. So we've made a bit of a reduction in costs to fit out. We've learned that we need to be in really good locations, and, you know, taking perhaps a site that's off the main business park by one street just isn't worth it. So, you know, it's worth being in the right place and having good quality sort of site manager or trade counter manager who's able to treat it as a sort of sales opportunity, and getting people in through the door is really important. So learned a lot along the way, and the rollout continues. We're looking to maybe complete the rollout in 2025. Large customers, a couple of pictures here of some success that we've had in the year. So again, as a reminder, there's sort of three main categories of larger customers that we group together. There's the house builders, there are the building merchants, and the retailers, the multiple retailers. Some of those are carpet specialists, some of those are not. And this is about a bespoke service. So we are able to tailor our service to meet those customers' needs. And this is where we're sort of stepping into relatively new space. So some of these customers already have other distributors' product in, but this is about a kind of value add service and trying to improve a service offer across the whole of the country on a consistent basis to a customer. So some of those images are from customer relationships that are either new or expanded to offer new products and ranges, as I said, across the whole of the UK. So you know, we're having success in terms of new customers and also starting to scale up customers. So this is about getting in, showing your service quality, and then expanding the ranges and the service that you offer to those customers. So far so good. Again, seeing some really strong growth, albeit off a relatively low base. We'll say we're trying to get to £200 million target sales here, which is less than 20% market share. So we think it's eminently achievable. We've got a new team who are having great success. So far so good on this space, and something that we will certainly look to continue this year. I'll just hand over to Adam, who's got a couple of slides just to finish off the sort of operational update, if you like, on what we're doing, particularly on the digital side.
Thanks, Chris. Yeah, so from a digital point of view, so in 2023, we saw 34% of revenue came through digital channels. Now that includes the electronic ordering coming from our larger customers, but also a good step up generally in terms of the amount of revenue that we're driving through those digital channels. And there's been a number of investments and improvements we've made in the year. So we've launched the first HEADLAM brand website, and there's a screenshot on the page there, and the link headlamgroup.com. So this is an opportunity where you can learn about the whole of the Headlam Group, what we have to offer, product, services, etc. Previously, we faced into the market a bit more in terms of our regional businesses, our regional brands. This is an umbrella Headlam kind of website. And we also launched a couple of B2B to C websites for 2 product brands. So these are websites where you can go on as an end consumer, and you can look at the product, you can order samples that will be delivered to your home. They'll be delivered to your home, then you can go and find a retailer to go and buy those from. And we launched 2 of those, making those much more user-friendly customer journey. And then during the year, we took the decision to replace the ERP. So Headlam for quite a number of years, bespoke coded system at the moment, and we're looking to move over the next 3 years to a more agile and flexible cloud-based platform to support future growth. And that'll be a 3-year program, modular, which will help it to make it smoother and minimize disruption. And we're not expecting any significant change to kind of previous cash expectations, IT cash costs that we'd expected over the last few years. Sustainability and ESG, I won't go through this in detail, but the key point just being here that there's been quite a lot of good progress on E, S and G. So some of the cost efficiency program that we've had over recent years have also had an environmental benefit. So the transport projects that we've had have taken out 20% of mileage, for example, in 2023. I forget the number, I think it's over 1,000 tons of CO2. So good for, make financial sense, but also good environmental impact. And there's been further progress across each of the E, S and G that we've set out on this page. Continental Europe then, so these we've got 3 businesses, and they make up about 80 million of revenue across the group. The largest individual of those is the French business LMS on the left-hand side. So that's about 2/3 of that. And LMS operates from a series of sites that act like trade counters and showrooms across France. It's a national business, and 3 distribution centres. We've got a new managing director there who's settled in well, and the business has returned to profitability. And a particular highlight of the last year or so has been the development and growth of the own brand ranges, and they're now over 40% of the revenue in our French business. And then our 2 Dutch businesses, one in the east of the country, one in the west of the country. One's typically had a residential focus, one more of a commercial. Key developments there have been in Dersima, which is on the right-hand side. The key development has been adding curtains and blinds to that offer to complement the flooring offer, and that's been through agents agreements and also an acquisition. And then the other development that we're working on is moving both of those businesses onto a common IT platform. So they operate separately at the moment, but we're looking to move those onto a common platform, which yields some synergies and better ways of working going forward. I think that's it on Europe. I'll hand you back to Chris for a wrap up.
Thanks, Adam. Okay, well, just a couple of slides left. So in terms of outlook and summary, I promised a bit of detail here. So yeah, we sort of segmented this into 3 areas really. There's what's happening with sales right now, so it's short-term performance. How do we see the rest of this year playing out, and then maybe a bit more of the medium-term outlook on the business. There's a couple of slides here. So, you know, what's happening now, not surprising, pretty tough trading continues, and lots of other businesses have been publishing trading updates since we did, actually. So the last couple of weeks there's been quite a lot, whether it's SIG or Travis Perkins or Grafton, or there's a whole host of people coming out at the moment on building materials, and also consumer facing stocks, all showing pretty weak continuation of performance from the end of last year into this. So yeah, that remains the case, and I think for us that still is the case, but with the positives that we saw in larger customers and trade counters continuing as well. So we're seeing more of the same from last year, really. And then what do we think for this year? So, you know, the outlook for the rest of the year, I think a couple of things have probably changed since November time, which we've reported on. You know, some of the sentiment of when will the green shoots come, you know, when will this sort of positive bounce in the market happen and the recovery commence. You know, some businesses have started to see that already, you know, things like, you know, mortgage applications starting to become positive, which is a great thing for the market, and hopefully will end up with some positive impact later in the year. But if anything, you know, this sort of continuation of the weak demand feels like it's here for a bit longer, and those stats and those metrics that we refer to, the RMI spend and the flooring spend outlook, both at the end of the year were forecast to turn from positive to negative. So that sort of negativity around volumes continuing for a bit longer, perhaps for 24, albeit with some green shoots showing that there might be some recovery later in the year, which just talks to the medium term. You know, this sort of 20 to 25% volume shortfall and recovery that one anticipates. Now, whether it's all of it or whether it's some of it, just that sort of feeling of it coming back. Now, whether it's as a result of this market recovery, the maturity of our broadening business model into these other areas, you know, both of those are going to work together to give us a material improvement in performance, profit and cash, altogether, and adding in that sort of reduction in the longer term capital requirement following the completion of the trade counter rollout. So positive outlook in the medium term, but I think it's going to be a little tricky maybe for the rest of this year. And then we were encouraged to put this slide together, an extra slide on, you know, what does that medium term recovery look like? What could it look like for our business? You know, and some of this information is already in the public domain that we've shared in the past. You know, our trade counters already at 100 million effectively of sales, looking to go to 200. That's based off growth in numbers and also maturity of that curve of revenue growth that we talked about, and that looks on track. Larger customers, as I mentioned, that's less than 20% market share. Again, this year we'll be getting close to 100 with a good opportunity list of things to go after. So again, you know, you can see that even on the subdued levels of volume being achieved. And then, you know, what happens in the regional parts of the business and sort of European recovery, and that's based much more on market recovery and how we see that maturing. And, you know, just assuming there's some recovery in that market performance, you can see the group getting back and hitting sort of the numbers of 900 to 1 billion sales or something of that nature once the market does recover. So yeah, just a couple of shareholders have said, you know, what do you see this looking like once all these bits have matured? So that's the slide that we put together to help with that conversation. So it just points to this sort of medium and longer term recovery of what the group could look like. So summary then, just before we perhaps look at some of those questions, even though Adam's answered one already, but just a sort of summary, just a handful of bits here, sort of 4 or 5 points on the left. You know, it is this resilient business model. We are broadening the business out to help offset market weakness, but also be ready for when the market recovers, because we want to be able to capture as much of the market now, but also the recovery when it happens in the medium term. I think, as I said, you know, there's likely to be a bit of continued weakness for a while until that happens, but we've got a business model that is resilient and well invested, with good stock holding, good facilities, good foundations, which means that it will recover and generate that kind of medium-term revenue and profit growth together with the cash in the future. So reasons to be cheerful in the future, I think, together with some short-term improvements in the way that we're broadening the business out in the meantime. So maybe we could go to some questions, and we've had some come in during the course of the presentation. So maybe if I just sort of, I'll go through them from the top if that's okay. and either myself or Adam will answer them. So the first couple of questions are around buybacks, so I'll perhaps ask Adam to answer these in a moment. But the first question is, what's the estimated benefit to shareholders from the Headlam buyback? Can it be quantified? And why has the board not pursued buybacks more recently?
Yeah, sure. So in terms of that first question then around the estimated benefit to shareholders, so the buyback program that started in 2022, it concluded about this time last year, actually. And there's 15 million in total of shares bought back. And what that's done that's actually reduced the number of shares in issue by about 5%, which is then increased, all else equal, increased EPS and then increased dividends per share by about 5%. So that's the quantifiable impact. If you're an existing shareholder, as a result of this buyback program, your dividend per share will be about 5% higher than it would have been had that program not taken place. And the main reason for the question around the board, main reason the board's not pursuing share buybacks more aggressively recently. So we've set out a capital allocation framework, and within that we've set out what we consider to be the right long-term average leverage range for the group. So that is 0.5 to 1 times. So that's what we as a board have concluded is where we think is the right kind of long-term average leverage for the group. And as part of that, what we've said is if we are below that range, so leverage is lower than the bottom end of that range, then that would indicate that we have surplus capital, and at that point we would evaluate either returns to shareholders such as buybacks or other growth investments such as M&A, and they'd be ranked prioritized equally depending on what was the best return to shareholders at that time, taking into account things like the share price, the prevailing share price at the time. So given that framework that I've just outlined and the capital allocation framework, that long-term leverage target, given that we're slightly over the top end of that range at the end of December, we would expect really to be considering share buybacks if we're at the bottom, towards or below the bottom end of that range, and that's when we would consider what we would do with that surplus capital that's available.
And I think it's worth sort of adding in there that's the stated kind of leverage range is where the board are comfortable on the capital allocation. So there's 1 or 2 questions that have been asked me in the past that why wouldn't you do something a bit more material to the balance sheet and restructure it? But it said it's all to do with the way that the capital allocation policy is laid out and the adoption of it. So I think those answers are covered as well. Just in terms of another question to do with property, Adam's answered the one around the market valuation, but there's also another question that says, is there a substantial opportunity to close or downsize unneeded space apart from the one in Stockport that was mentioned on the presentation? But I think this is something that we are mindful of and opportunely looking at the efficiency of the network. And I mentioned one of the key kind of 5 pillars on the strategy was looking at efficient operation and how we structure our business. And that's constantly under review, and indeed sometimes requires some technology in order to liberate space and efficiency. And that's certainly what we've seen with the transport network. And Adam alluded to 1 or 2 other sites that may become free as a result of deployment of technology and new operating structure and network. So that is something that may well happen later in this year as we see it mature. So yeah, it will probably be something, but maybe in the 1 or 2 sites rather than something more comprehensive. Okay. Adam, maybe a question for you. You sort of half answered this, I think, but how much would you estimate maintenance capex is going forward?
Yeah, so you'll recall that slide I put up where we showed the capex over the last few years, and prior to the investment phase we're in now, with trade counters and also with solar panels that we'll be investing in 2023. So prior to that phase, we're about 4 or 5 million a year of capex, and we're guiding to 12 million this year, and then once we get through the investment phase on trade counters, we'll expect that to drop further. And I mentioned probably drop into the kind of mid to high single digit CapEx numbers going forward on a long-term basis. So that's kind of about, you know, a good estimate for maintenance CapEx going forward. There might be a little bit of growth in there, but you're kind of in the slightly above the historic average of 4 or 5, but kind of in the 5 to 8 range on a long-term basis going forward. And Chris may have frozen, so I'll just pick up the next couple of questions. I don't know, Chris. Why don't I do there's one on bad debt. So the question is, how much was the bad debt expense or benefit in 2023 and 2022? And approximately how much is this typically in an average year? So bad debt expense for Headlam has been tracking about 0.1% of sales. So it's quite a good. I was quite pleased at that when I joined a year ago, and despite some, you know, despite the market impact and some sort of potential distress in some of the smaller customer base, actually holding on to that 0.1% of bad debt expenses, it has been a good result. That though, that's our underlying expense before any changes in provision movements and things like that. So there's an underlying expense of about 0.1%, which is about 0.6, 0.7 million a year on bad debt. So that's an expense. There was a one-off benefit in 2023 and to a lesser extent in 2022, but a one-off benefit in 2023 from the reduction in the provision, which I mentioned earlier. So that was about 2 million reduction in the provision, and that's because the overall level of receivables has come down, and the aging profile of that. We worked hard in the year on cash collection, so the aging profile improved in the year as well. And as a result, the provision came down in 2023.
Thank you. There are a couple of questions on, I think you lost me there for a while, I came back on, but a couple of questions about the sort of relative strength of our regional distribution offering, and how competitive is it when you compare it with other distributors and manufacturers, maybe with their own national distribution networks. So, I mean, the answer for that question there is that, you know, what we've got is a bit of a blend. So we can offer UK-wide distribution across multiple kind of manufacturers, product brands. We can white label some brands for customers. So I think the ability for us to bespoke our service. Now, you know, our service isn't unique either in terms of product or indeed coverage, but what it does is it has this sort of combination of consistency, UK-wide coverage, and our ability to curate products for a bespoke service for customers. I think that's the difference for us. So, you know, as the question alludes to, some manufacturers have their own service into UK customers, and that will be fine for some. But as I said, what we're trying to do is identify an area where we can add a value add, you know, a distributor wrap or a bespoking to a customer that makes it hard for manufacturers to do that at a sort of granular level in a consistent way across the country. Last question that we've got, are you looking to deploy learnings from the UK operational improvement programme into continental European business to potentially underpin future acquisitions? So that's sort of two questions in one there, I think. So if I try and answer that in two ways. So the first one is learnings from UK operations into Europe. So how relevant is the UK distribution model, if you like, to the overseas territories? And I think, you know, there are some learnings. There are some learnings from the deployment of technology, which I think helps. But we do operate the models in Europe in a slightly different way. You know, whether it's some of the territories we don't operate our own transport network, and some we do. Certainly access to products and the way in which products are innovated. Certain technologies and warehouse scanning solutions and things do get deployed across the European market to improve efficiency. So I think there are some learnings where they're relevant, and indeed we have a kind of European, the European leaders come together, they come to the UK, they see how we operate things, and vice versa. If there's any learnings to be had from the European market in the UK, we look at that too. I think in respect of underpinning future acquisitions, there is certainly nothing planned at the moment. So the markets are quite different. We do see the biggest opportunity for us in sharpening the offer in the UK. Really, as Adam said, the French business is the largest in Europe, but that market is very different in nature and size and scale to the UK. Very much dominated by the larger retailers, and much less so distributors. And the Dutch market is slightly different. Dutch market is a bit more of a distribution offer, smaller territory, density of population is better. So I think there's more opportunity for us to consolidate our own businesses and offer a more cohesive structure and business in there. And there might be opportunities that come along, but as I said, there's nothing on the table at the moment. And Alessandro, I think that brings us to the end of the questions. So I think it's probably back over to you.
Perfect, Chris. Adam, thank you very much for answering those questions from investors. And of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Chris, could I just ask you for a few closing comments?
Yeah, thank you, and thanks to everyone on the call for joining the call, taking the time to meet with us, look at our slides, and ask those invaluable questions. So thank you for that. But in summary, it's just as I said, we've held on the last slide here, which is helpful. The business is resilient and has got a great balance sheet and a great range and legacy of customers and heritage with customers and a growth plan. We're doing well to grow into these areas despite the marketplace, but the market is challenging and it's likely to remain so for a little longer. But I think we are starting to see some green shoots in the macro, which hopefully will help speed up that sort of recovery in demand. And at the same time, the maturity of our strategic growth areas will mean that we should have a more positive medium-term outlook to share and a recovery in revenue, profits and cash as well. So yeah, tough short term, but the medium-term outlook is certainly more positive. So thanks for joining the call today.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will then take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Headlam Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.